funding costs, and that will be positive for the economy at large.
Bill, as we look at the market action today, I mean, clearly ticking up. We're at session highs today. I don't know if that had exactly to do with what Fed President Bostic was saying, or just sort of the general sentiment that maybe we shouldn't be as worried as we were when we first saw those numbers, now that we've had time to digest it. What do you make of today's action?
Yes, see, as everybody's reiterated here, CPI was digested very, very quickly. I think the Fed sort of has a decision that I still think May is on the table, and I don't think this disrupts it. The odds are still, 1/3 of a chance that they do cut in May. Shelter was a concern there. You look at new home sales today, was a big miss in the data. I think that's something there. I think yesterday the market was able to actually react very positively when Fed Governor Waller, who's known to be very hawkish, didn't really push back on pushing rate cuts out further. And no comments actually went a long way in helping lift the market. The other thing here, as you started to talk about too, is leadership. There is really good leadership, not just in AI, but today's PPI data from a producer price standpoint, you're seeing construction costs, they're starting to trough. And so this is really good news for the industrial companies like a Caterpillar and United Rentals. I think the market, everybody's really focused on AI, but I think the leadership starting to broaden out just slight bit enough that where you're able to get the market to rebound like it did from a CPI number that happened.
That's a good point. I mean, Bank of America's Michael Hartnett actually notes today that material funds, largest inflow since April of 2022. Tech funds, though, of course, still very strong, 6th straight week of inflows. Joe, if you're going to put money to work in this market after you've heard about the data this week, does anything really change for you?
No, I thought you were going to ask me where I'm putting the money to work, because I obviously have an active ETF strategy. So yeah, that's where my money is going right now. I think that, does anything change? No. When you're looking at the totality of 2024, I don't think anything changes. Would I be surprised to see the market over the next several weeks correct some of the technically overbought conditions? Absolutely not. And certainly with that big earnings report coming next week. What's that company again, Bill?
little company named Nvidia.
Okay, the star of 2023. The expectations are incredibly high, and I think the market will respond, in fact, to how those results are reported. But more importantly, what's the response to the results themselves? Because the results from Nvidia could be spectacular and the stock could go down, or the results could be tepid and there could be the buy the dip mentality. So I think a lot hinges on that report next week. Overall, long-term bullish, near-term, wouldn't be surprised if we work off some technically overbought conditions.
Can I add something to what Bill said earlier? So I think we're talking about leadership, and one of the debates that we've continued to have on this program and across the network over the last few weeks is whether the markets are broadening out or not. And I think one of the things when you see those risk-on days, you're actually seeing some broadening out outside of U.S. large caps, outside of mega caps. So I think we're continuing to see that concentration in terms of performance in those top 5 stocks. I think that, when we're looking for broadening out, I think when people are looking to add some additional exposure, they're not looking at sort of those other sectors, but we're starting to see some indications that we are. There's also this big debate about whether cash on the sidelines is going to come back in.
Yes.
We think that that's going to be a driver, but if rates stay high, if we're still anchored in the short end of the curve where we are today, and that persists through June, that might be delayed until the second half of the year. And so we could see this concentration persist.
And Barclays basically saying cash staying put for now.
Which is ridiculous.
You think?
It's ridiculous given the earnings that are being reported from technology companies, the earnings that are being reported from the S&P, the growth that we have present in the market, the acknowledgement that the Federal Reserve is no longer adversarial and a disinflationary trend. If you're parked in cash and you're seeing what risk assets are doing, what are you waiting for? Well, what else are you expecting?
They always wait, though. Actually, until you start to see that movement of cash.
I do believe that cash is and should be coming off the sidelines. It doesn't necessarily have to happen today and ahead of Nvidia earnings. And I do think the market could take a breather. I'm calling it leveling out a little bit after Nvidia earnings. I don't want to get too much in the weeds, but there's a heavy call skew, so a lot of speculation in Nvidia. When you see something like that, a lot of call options being purchased into earnings, similar to reaction I'd expect that we happen in Nvidia in August. We go through a little bit of a seasonally slump in the back half of February and sort of trot through the spring maybe. But I think cash will come back into the market, as I don't expect yields to hang up up here. I think 4.3, maybe 4.4 in the 10-year is about as high as you can get. You're seeing 2-year yields continue to slug higher a little bit, and that's going to continue to keep maybe cash in the money market. But I see that unwinding as we get into the summer. And guess what? The stock market is at record highs, and when people see the stock market just sitting and consolidating out above record highs, they're going to want to participate. Let's not forget we're in an election season. There's a lot of tremendous, really bullish tailwinds here, and record highs typically lead to further record highs.
Go ahead, Joe.
No, I don't.
Next year, 2 years. We need that sustainability to keep that conviction in the market for this AI trade. And that's what Nvidia can show us next week.
So much hanging on that report. Bill, I know you don't own Nvidia, but you do own ARM.
I do own Nvidia.
Oh, you do
it's
own
actually
Nvidia.
our number 4 position.
Oh, thank you for correcting.
I've been right. It's been a big leader of ours for a while, and we've had to kind of just work through managing that from a portfolio standpoint. And we cut it by a third ahead of AMD's earnings, and it's right back into number 4. It went down to number 9. Now it's number 4. And as I mentioned earlier, I'm excited for these earnings. I think, though, when it comes to everybody's expecting something, we've continued to see price targets rise and rise and rise. It creates and feeds speculation, and that speculation needs to unwind. And again, I don't want to get too much in the weeds, but I'm looking at the call skew here. There's a lot of calls being purchased. People sell those calls. The market makers do, and those things have to start to unwind once that risk is known of earnings. If it's not an absolute blowout, but even if it is a blowout, I think some of that could unwind and we go through a consolidation similar to what we had after August. But overall, though, I don't think it derails the entire play here. I think the AI play is going to continue to build as the year unfolds. We do own ARM as well, and it's a small position in ARM to start, and right away it took off. I'm more or less just kind of waiting for this to consolidate. I know there's a lot of speculation out there about ARM with the I think it's a March 12th lockup period that ends for holdings. It's SoftBank, and I think some of that is something that you have to be aware of in some of these stocks like an ARM, or you're watching a super microcomputer, the volatility that these things happen, and it just continue to fuel a lot of speculation. But it's important to manage your risk and know what you're expecting out of this, and that's why we're positioning sizing in something like ARM small enough that we can withstand the volatility, but we plan to hold it for 3 to 5 years. I think that thing could 4x over that time, if not more.
Wow. How are you managing? You have both in your Joe T.
From an industry perspective, semiconductors are by far.
This with Bank of America.
I've been planning to add more to Bank of America for really weeks, and kind of waiting once we got through this earnings report. But the problem was that with the Fed expectations, they were looking for rate cuts too soon, and now the 10-year yield has risen back up to 4.3. I think it's appropriate to start looking at it, because when the 10-year yield rises, Bank of America has traded poorly. But one thing I like to see this week was the yield rise, and the Bank of America actually traded really well. So that was my catalyst to really kind of push into that. I think net interest income is going to be something that continues to improve. Maybe the way it traded here is because of the New York Community Bank and all the negativity about some of the regionals that's now been flushed out, and now the Bank of America doesn't have those sort of handcuffs on it, which I like that quite a bit, and that was my catalyst in really pulling the trigger now.
Wait a second. You're a futures trader, so you follow momentum. Why not Citi? Why not JP Morgan? Why not Wells? That's where the momentum is the last week. I
agree with you, and JP Morgan's setting highs. And we do own JP Morgan, I think, and I've talked about when we added JP Morgan at the fourth quarter, was, I want to have that exposure in case Bank of America doesn't come out of the hole. But I think Bank of America can outperform a bit here and play a catch-up trade. And that's sort of what I'm looking at from that angle.
Okay. You also bought more Tesla.
Yes. Yeah.
Why now? Why here?
I talked about it, I think it was last week on the show before I got into the trade. I think it bottomed out. It held a technical level of support. And like Joe just said, I'm a futures trader. And when things don't continue to go lower and they respond to technical support, that was my signal to get in. And the market has started to turn. I think the negativity, I highlighted that last week, the negativity here has really peaked around Tesla. And it's really started to break out of a little bit of a consolidation pattern through yesterday's trade. I think they'll figure this. You see SpaceX being moved to Texas from Delaware. I wonder what they'll do with Tesla. I think that that would probably move. You start to work through some of this compensation package from Elon. I still wouldn't be surprised to see Elon himself buy stock and increase his position. But once they kind of work through some of this that's been going as a headwind, I think Tesla can start to trade a bit higher.
You're shaking your head. You don't think the negativity didn't work down?
No, I'm shaking my head because on the first business day of February, I came onto the network and I said we added Tesla to the ETF. Discretionary Joe would not have added Tesla to the ETF. We added it at, I think, 186. Non-discretionary Joe added it, and non-discretionary Joe seems to be right now. So you follow the rules, you don't follow your intuition, because I thought Tesla was going to break down below 175.
Discretionary Joe, I like that. I'm cautious, Courtney. Not with trading, just life in general. Okay, finally, Bill, you trimmed Cheniere?
Yeah, Cheniere's been a holding that we throttle in and out of quite a bit, and it's been in the top 10 before, which says a lot about my love for this name and this stock. But here's the problem. First, the good thing is they don't get paid on the price of natural gas. They get paid on shipping volume, and they got a foothold in that space right now because these export bans that are building out for years to come, I think that will get resolved. But the fact that they're not resolved, it became the last shoe to drop for natural gas. And I do fear here, from a momentum standpoint, when you see a market, especially a commodities market, sell off in the manner that natural gas has sold off recently, you usually don't get a bottom until you get a big capitulation. So I don't want to be in a larger position than I should have in Cheniere, and then the baby gets thrown out with the bathwater if something like that were to happen.
So you're not questioning kind of the longer-term tailwinds for natural gas, for LNG here, because, I mean, I think we all can admit, even though we're down from September 22 highs, that there's a lot of opportunity in terms of the switch from coal to natural gas, and that, they will benefit from export volumes of that.
Yeah, absolutely. The supply right now is well above like the 5-year average. It's well above. So right now there's an oversupplied market, and the producers are continuing to produce right now. I mean, they need the industry needs to have a capitulation of where they have to shut down the production here for some reason, and the lower prices could be what maybe the spot prices at 50 cents. You look at some of the future prices going out to March, April, May, or above $1. If those future prices, those forward contracts start getting below $1 at some point, that's going to be maybe signal some capitulation here.
And Joe, you own Valero, but then more energy names in the Joe T.